Alright, I'm recording.
Alrighty, so today we're going to be talking about gamma exposure and delta and kind of how to trade with it and navigate the markets with it. Um, I know it's kind of a foreign concept to some people, and a lot of you guys just trade tickers, but I think this will give you a better understanding of how to find some market alignment and why the market actually moves the way it does every day, because nothing in the market is random, as I'm sure you understand just by trading with TA every day. Um, So this is kind of what I'm going to be covering today. We'll go briefly over the Greeks. I hope you guys have a basic understanding of what delta and gamma are, but I'll kind of go a little bit deeper in this session. I'll give you some samples of the GEX map and kind of how to read it. There's a couple of tools you can use out there. I'll go over that at the end of the session, but I'll give you a few examples how to read it. Go over market makers, kind of the dealers that are trading alongside you every day and actually are pushing the markets and why they kind of operate the way they do. Um, I'll also go over some regimes. The two most common ones, as you probably know, are positive gamma and negative gamma. Kind of go into those and how to trade them a little bit. We'll go into Charm, which is kind of a neat little tool. Um, it's not as effective as GEX. I think if you're learning about this for the first time, don't worry about this too much, but it's a neat little tool that can really be used if you're an SPX trader mainly, but I wouldn't worry about this too much, so don't worry if you get a little lost at this point. And then finally, I'll go over kind of how to trade with GEX overall and kind of the key takeaways that you should take away from this session. Um, GEX isn't a standalone tool, as you'll learn by the end of this. So what the heck is delta and gamma? So if you are trading options, I hope you know what the Greeks are, but essentially delta measures how much your option positioning is moving for a $1 move in your underlying asset. So if you're trading a SPX contract with a zero point 0.6 delta, if SPX moves by 1 point, your option is going to gain 60 cents in premium essentially. Calls give out positive delta, and puts will give out negative delta. Gamma is kind of your accelerant. It affects the way that delta will move itself. So for every $1 move, gamma will shift your delta even more. Um, so this is the combination of these two is what causes that ramp up in your options. So whenever you're trading a strike, let's say you have SPX 7200 calls and SPX is at 7180 right now. Whenever you're trading this, you might notice that, SPX is going up a little bit. You're not really getting that much return. Maybe you're up 5%, 10%. And then shit, all of a sudden, as your strike is closer to being at the money, your option is now up 120%. So this is what causes that ramp up, and this is how you want to be picking your strikes and options. You don't want to pick anything directly at the money typically because this is not the best bang for your buck. You want to pick something where you're actually targeting price to go, and if you're right, you'll get paid for that. And as that goes above at the money, you'll see less return in value, but that's where your runners will continue to pay.
Yo, Jeffrey.
So, yeah,
Everybody's only seeing the first slide right now.
shit.
Do you wanna redo?
Yeah. Can you guys see it now? I guess I'll have to. You guys able to? Maybe I'll just do it from this view. Can you guys see this fine? Okay, cool. I'll just do it from this view then. So this is what I was kind of talking about with that delta ramp here. So you can kind of see where your best bang for your buck is out of the money, and then as you get at the money, that's kind of where that delta ramp occurs, and that's because gamma is accelerating it. And as your runners continue to go, you'll get some good return, but eventually it'll cap out. and you won't get the best returns. So this is what gamma exposure is. The way I look at gamma, it's an aggregate of all the gamma of all open interest. So it's basically a map of all customer positions and how market makers are positioned against that. And I'll go in a little bit more depth in that in the next slide, but just try to kind of focus on your gamma regimes for now. So the right side here is going to be your positive gamma. So this is when market makers are net long gamma, and these kind of act more as pinning action. So what that means is you will see typically some choppy price action here, some ping pong effects. You won't really get any large breakouts in these areas. So when you're taking these, you want to be mindful of the environment you're in and you want to position yourself with that. You want to know what to expect based on your gamma exposure. The left side here is negative gamma. So this is when they're net short gamma, and this is going to be where your big moves happen. Um, this is when dealers will be trading with you. They will be buying into rallies and selling into dips. Um, what I like to look for here is typically these gaps. If you see on the right side here, these are when your breakouts will happen. This is when you'll get a breakout move, and then you can basically target the next positive gamma strike, and that tells you pretty reliably when to get out of your position. Um, it doesn't mean that your position will automatically be rejected here. It just means that price will start to be dampened here. So you're not really getting the best price action at this point, and it's better to just get out if you're on SPX, of course. Typically, the biggest aggregate gamma that you will see is at the money contracts. This is because the same gamma out of the money needs far more contracts for dealers to hedge against. So at the money strikes will typically dominate. I'll go a little bit more into depth on this since it has more to do with dealers. But from here, from this chart, just take away uh, positive gamma, the negative gamma, the gaps, and understand that this is the dealer positioning here. I'll go into depth why we don't really care about customer position overall. So why do we even care about this stuff? If you didn't know, whenever you're trading an option, you're most likely not buying it from a retail trader. You're most likely buying it from a market maker. Um, how they make their money is from the bid ask spread. So whenever they are selling you a contract and you're buying it, they are making that small amount of profit from the spread, and that is how they typically run their business. So if you are buying an option, they are taking the other side of it. If you're buying SPX 7200 calls, they are selling that to you. And what their goal is to mitigate risk. They don't care what the market is typically doing. A typical misunderstanding is that, oh, I got stopped out because this market maker dumped the market on me. That's typically not the case. They're just reacting to what their book is. Their goal is to maintain risk and have a flat book at the end of the day. Um, and that is the concept of staying delta neutral. Whenever they are selling you an option, you're buying it, they're delta neutral at that point. When price moves, they will have to hedge it by selling or buying futures on SPX, of course. And SPX, as you know, you can't trade shares with it or anything, so they're using ES as their tool to do that. So breaking it down into 4 easy steps here, you're buying an option, they're selling it to you, they're delta neutral at that point, and as price moves, as your contract gains or loses value, alongside millions and millions of other traders, they are transacting millions and millions of trades every single day. And kind of how this helps us is that now we can infer what actions they might need to take to stay delta neutral. So going back into this chart here, you can kind of see why dealer positioning matters more than customer positioning. There's no telling what a customer might do. Jimmy might hold his SPX contracts until they expire at zero. That's totally fine by a market maker. They could go 1,000%, they can go minus 99%. The market makers don't care. Customers are unpredictable. There's no way to tell what they do, and realistically, they don't have to do anything. It's the dealers to run their business to stay delta neutral and mitigate risk. They're the ones that have to take action. So that is why we don't really care about customer positioning. If you see many tools out there that provide you with customer positioning, that can be valuable to give you bullish or bearish bias based on what orders are coming through by customers, but the reality of it is that there's nothing really there that is actionable on your part. So, positive gamma, how is this even created? When a customer is selling a call or put to collect premium on that, a dealer will buy it, for example. This causes the dealer to be gamma long. And a common misconception in this is that, for example, a long put will have negative delta but positive gamma. Gamma is always dependent on whether the option you are taking is long or short, not a call versus a put. So if you're buying a put or you're buying a call, that is long gamma. And kind of something I was talking to Gumball, this is why some of these tools also aren't very useful, is because they are assuming that calls are bought and puts are sold. So essentially, what you would get in that case, if I imagine that calls are bought and puts are sold, is, let's say I'm trying to find an entry at 74.90 here. I think that SPX is gonna break out above. I'm seeing it's compressed at the EMAs. It's holding this level really, really nicely. Well, what this could actually be, if I was looking at it from naive gamma, is what we call it, this could actually be negative gamma instead. And instead of me thinking that it's going to break out and that I'm going to get a nice rally working with the dealers, I'm actually on the opposite side of the trade, and if this dips, then I might get caught into some downside here. So all of this would essentially be flipped if you're looking at it from that case. So you want to make sure that you're using a tool with net gamma. So it has all sides of the trade. It has, for example, long calls and short calls, long puts and short puts. That way you're getting the full picture. Otherwise, you're essentially entering the trade on the flip flop every single time. So this is kind of one of the regimes. So positive gamma is when price is going to be stabilized. Dips are going to get bought in this case. Rallies are going to get sold, and you're going to see some mean reversion. So if you think about every time you've entered a trade and chop and you think it's going to break out, oh, it doesn't break out. Okay, whatever. It's holding this. Oh, okay, it might break out again. No, dang it, it didn't. You're essentially just playing in positive gamma and you're just getting chopped around the entire time. It's important to realize this if you're trading in a node like something like this up at the top. There's no real direction for price to go when you're in a huge positive gamma node. You're likely just going to get chopped around. And if you're in a different trade, maybe you're like midday in a stock or something, and you're wondering why is the market not aligned with me? It's usually the case here that you're stuck in choppy price action, and the market's just not going to align with you for this reason. I think I'm on this one. Negative gamma. This is where the fun is. So whenever you enter this regime, These are when our rallies occur, these are when our sells occur. As price drops, dealers are essentially forced into a chase mode. So they're going to be selling into weakness and buying into strength. These are when your big momentum moves happen. This is what we saw all throughout March and part of April. I think like maybe the first couple of days of April. Um, so when this happens, this is when you want to be in a trade. You want to be in a trade whenever you're getting these gamma flips here. Like I was saying earlier, kind of when you're on the edge of this and you're seeing price slowly head up into negative gamma, that's when you're like, okay, this is working in my favor. I need to hold on to this and let it work. Now, this is also double-sided, as I'll go into a bit later. If you are trading in negative gamma and sellers show up, then that causes what I like to call a rip and fade effect. So, for example, if SPX breaks out here and sellers start to show up, what does that cause? That causes dealers to also sell, and that will cause your kind of fade effect. So it's important to keep in mind, where I'll go into this later, is why GEX alone isn't enough. It's a tool for you to understand your environment that you're trading in, but by itself, it's not the key to everything. So this is kind of a summary of it. All you really need to know and focus on is the behaviors of both. This is the main thing. If you're going to take away anything from this, all my mumbo jumbo, then keep these behaviors in mind. And keep in mind that you ideally want to be entered at a gamma flip area. So that's when you really flip from that against the move to with the move behavior. So there's also this cool little thing, and I think Gumball might like this. It's charm. So how charm works is that we all know what theta is. So if you are trading something like a 0-day option where delta is very, very low at the end of the day, there's tons of contracts about to expire worthless. What does this cause? This causes a strong rehedging across dealers. They will be dropping many out of the money contracts that customers are buying at the end of the day. So, what will this cause? This will cause a massive rip into the end of the market sometimes. That's ideally what you want to see. Uh, on days of chop, wherever dealers are already hedged for the day and price isn't really moving, it's obvious what contracts are already going to expire worthless. For example, if SPX is like at like 7,200 and, Jimmy's buying a 7,300 contract thinking it might rip there at the end of the day, you're not really going to get anything from Charm. And I'll go in how to read this, but you can kind of see when that pressure is the most extreme. And it's usually around that 2:50 p.m. Central Time. So how can you read this? Best way to read this is from a heat map. So how charm works is that negative is blue here, positive is yellow, and in any area where it's blue, that means that price is not being supported. That means that dealers are passively selling ES futures. As you go into yellow areas, that means that price is supported and that they are going to be passively buying ES futures. I don't know if I said sell or buy, but blue they're selling, yellow they're buying. Uh, and what kind of happens at the end of the day is that you see all these little pockets. Price will tend to gravitate towards one of these yellow pockets at the end of the day. Um, and you can kind of see how they become more and more narrow at the end of the day. Here, you start out the day kind of in a large field, But as price is discovered throughout the day, it'll be pretty apparent where your options are to head at the end of the day. For example, I took this screenshot earlier. I think we ended the day at 7565, somewhere around there. So we actually, I think we dipped a little bit into this where price was supported, and you can see we actually ripped up a little bit. I believe that's what happened. Don't quote me on that. Um, but what you can use this for is for finding those massive, massive moves at the end of the day. For example, if I was a degenerate gambler, I would might want to make the bet that price would end up here. You know, it would kind of make sense from this picture if you're looking at it from this point of view, that price may just gravitate towards here at the end of the day. And what this can cause actually is if I am in one of these little pockets and I'm kind of riding price here, you can get a nice little rip into the end of the day, and that will be supported by charm since the amount of contracts that are expiring worthless are being rapidly hedged at the end of the day. So they're going to be either buying a massive amount of futures or selling a massive amount of futures at the end of the day. And if this doesn't make sense, honestly, don't worry about it too much. This is kind of a little bonus. You can kind of use it throughout the day, you know. Let's say I'm thinking about entering some sort of flag trade here or something. I might think that, if this works out, if there's like a 10-minute EMA or something here, then maybe I might think that, hey, we can move up into this supported price area and maybe get a rip higher. You can kind of use it for that, but just know that over time, at the end of the day, is when this really comes into play. A use case is if you have like a 1 day contract or something, and you want to try and get a rip into the end of the day, but you don't want to play 0 DT like a degenerate 10 minutes into the close. I think this is just another example here. So I kind of made this chart here to make it a little easier to understand since I know the options depth might be a bit confusing. So this is kind of what you can see in a GEX setup. You would get a giant positive GEX area. This would kind of be where price is pinning and kind of magneting towards. I try not to use GEX as a magnet tool since price will change throughout the day. So for example, I could think that, oh, we're going to 7160. I'm going to totally just full port everything and think that we're going to make it here because this is a large strike. Well, what happens if this gets closed? Then you're just stuck in a trade with little to no thesis. Um, but imagine this is an ideal case. So in this trade, I would look for a breakout to a lower positive GEX price. This would mean that price is getting pinned less. And if this gets unpinned, so imagine this gets a little lower here, then all of a sudden I could be entering some negative GEX here. And what will happen there? I can run up to this strike here. And if this strike increases, that is when you want to get out of your trade because you're going to start chopping up there. And what would happen in the case that this, let's say I enter down here. Let's say this gets bigger. Let's say this is all the way up here now. And let's say that this decreases. Then I know now that my trade to the upside is less valid because I have a large pinning and large dampening of price above. So here are kind of some setups that you'll see over and over and over again. I see these almost every single day pretty much. Uh, you'll see a single dominant strike. So throughout the day, especially as you get later into the day, into the afternoon, um, you might see something like this, where price is just moving about five or so points up and down every single minute or so. I see this about 75% of the time, to be honest, throughout the later day. So that's really garbage trade. You don't want to be entering that. You want to be waiting for uh, the later day when stuff gets more violent. Um, the buyback rip and fade. I see this a lot, and I honestly think this is very underrated. So let's say, for example, I have a now negative GEX strike down here. Or let me do this actually. Let's say, for example, I have something like this showing up on GEX. So what the buyback is if price moves under this negative GEX strike and reaches a point of dampening and customers trade right through this strike again, what will that cause? Let's say this is short puts, for example. This will cause market makers to be forced to buy those back. And what happens when they buy those back? That creates a massive V shape in the market. And this is why in bullish markets you actually see mostly, I want to say every single day at this point, honestly. I know it happened a lot last year. You'll just see massive V shapes every single day. You'll see a put spike hit the flow, and then the market will just rip back up about 10 to 20 points. But this can also work against you. And if you're in a more bearish market, this is kind of what we saw earlier this year. You might see something like this, for example. Yes, it does. That is the same thing as essentially having a large positive gamma strike. When you think of it as a magnet for positive gamma, in negative gamma, it will be more of a whipsaw. So if you have massive negative gamma, it makes the move more violent. So let's say I have a, let's say this is a giant negative GEX strike. What will happen is that means the dealers need to buy or sell more aggressively through that strike. So it's the same concept on both sides essentially. So if you see a big positive gamma, that is a bigger chop, bigger negative, more violent move. So on the rip and fade, what you will see in more bearish markets is you will see something like this. Let me actually do this. Let's say you rip through up here and you think, okay, cool. We're now approaching this positive gamma, things are all hunky dory. Well, what will actually happen is this move might get faded, and that will cause kind of what you see as those carrot tops in the market. And those are super common in bearish markets as you see rallies get sold every single day. And I'll kind of go more into depth on this of how you can identify this a bit more and why understanding your environment is very important, especially on trading the indexes. Another thing you might see is negative GEX with two positive walls in between. So what this would look like is, again, maybe something like this. Like this. So if there's no real action on the day, let's say we have little positioning here. And actually, let's say we have little positioning on both sides. So this would be your typical range day. So your price is being dampened at both sides, but it is actually able to move quite a bit because you have some negative GEX in between. This would be your typical range day scenario. And then the opposite here would just be the positive GEX in between the two negative walls. So this is where you would see kind of a whipsaw effect. So you might see price try to rip above and it would kind of be a wave effect. So you would get breakouts, but they would get faded above back into positive positive strike, and you might get dips below, but they might get bought back in to the positive strike here, where you would eventually probably chop out if you were to reach here.
Somebody
So
asked,
while you
does the magnet act both ways? Like if there's massive positive gamma on the upside and downside, would the dealer pull the price to the downside strike instead of trying to cap it at the next higher strike? That made sense.
let me answer that one at the end. That one was kind of long.
Okay. Sorry.
No, you're good. Um, okay, so like I was kind of hinting to before, GEX is a cool tool and it is really useful, but you can't use it by itself. That's just the way the market is. Your charts are there for a reason. So, how should you actually use this? GEX should be your read of what environment you're trading in and what is the potential of the trade you're entering. You know if your trade is going to chop out or if you know if your trade has potential to run. You should always pair it with some actual TA that you have and ideally some sort of market breadth. Um, One of the most key tools I think that you should at least take a look at and be mindful of what it's doing. Honestly, maybe not now because the VIX is just killed. Um, but the VIX will always tell you what kind of environment is potential in the market. So if you don't know what the rule of VIX is, it will tell you essentially what kind of intraday move you should expect in on SPX every day. And SPX will essentially give you the tools to the market to understand the volatility. Though those two paired together. Um, VIX will let you know if you are in a fearful market or a greedy market. If the VIX is being slaughtered every single day, you know that is a greedy market. If the VIX is constantly shooting up every single day, then you know you are in a fearful market. Um, your EMAs, Chris has preached this every single day. These are telling you the fairest price to buy an option at, to buy a stock at. If you are too far away from an EMA, the chances are you're not getting a good entry. You're getting an unfair entry and you're being scammed essentially. You should also be mindful, are the EMAs crossed above each other? Are they below each other? Are we above a high value EMA? Are we below a high value EMA? Those are the signs that you're trading in a bullish or bearish environment. Levels. I can tell you, if you're trading an inside day on the index, you're likely going to see something like this on GEX. You know, it's pretty evident that this is an inside day just from looking at it. You're not going to see a giant pool of negative GEX if you're trading an inside day usually. Um, you need to be mindful of what to expect out of the day, and GEX will help you navigate that intraday, but you need to understand that on an inside day, you're not going to be hitting those massive trades usually. And the Mag 7. You should understand what is the overall health of the market, especially with the mags weighing a significant amount on the indexes, more so on QQQ since it's so tech based. But I threw this 30%. I'm pretty sure it's much more than that. If mag sevens are struggling, then you know not to expect much in the market on the bullish side. They will either help you get those massive trades, or they will be your worst enemy if you're trying to be a bull when they are weak. And a bonus that you can read up on is cumulative volume delta. This essentially will tell you what is actually going on in the background in the market. For example, if SPX's price is moving up, but volume delta is reading weak buying, I should say, then you know that that is a weak move up. That is what we would usually call a CVD divergence. This is just a bonus if you want to read up on it. There's also more market internals that you can look up, like cumulative tick, if you're interested in that. So in practice, what you should really be doing is identifying the regime. I know I say blue map and red map here. It's because I was gonna pull up the actual calls versus put side in this, but unfortunately the tool isn't working today, so I only have the net view. But you should identify what regime you're in, what environment you're in. Are you actually going to get the move you think you are? Are you going to get the market alignment you think you are? Or is it really just not going to work out and you're just clinging on to false hope? Find the magnets on the GEX, find the biggest strikes. Look at this continuously throughout the day. Gamma shifts every single minute. Most tools update about every 10 minutes or so. Uh, but just because there's a giant thick 7400 on SPX at the beginning of the day doesn't mean that's going to be the same dealer hedging in 30 minutes. It changes throughout the day. Don't get caught in a trade that you thought was going to work and now it's not valid. Map your gamma flip levels. These are the most important levels throughout the day. Look for these gaps. Look for where net gamma is turning from long to short and vice versa. Those are going to be where your big moves happen. At the money positioning, um, get good contract value. Don't enter junk contracts that you'll never get the delta and gamma benefit from. If you're entering something that's 30 points out of the money, 40 points out of the money on SPX, even if price moves your way, you're not going to get good value out of those contracts. They're junk and you shouldn't trade them. Use charm later in the day if you want. Look for these little seams to understand where price can possibly go. Um, this is a bonus. You can use it if you want. I only recommend it for lottos on SPX. Otherwise, don't really worry about this. Only worry about it if you're really interested in knowing what's going on in the background throughout the day, if price is actually being supported or not. And finally, this is the most important part. Confirm it with TA. Don't enter a blind trade just because the gamma looks good. You will probably get burned. You need to have your levels marked. You need to understand the EMAs on multiple time frames. Master one time frame if you need to, and just get really good at that over and over again. GEX is not a tool that you can use on your own. It's the environment only. Uh, you need to make sure your TA is aligned. If your TA is not aligned with it, then it's no trade. And then the VIX. Learn about the VIX. Learn about what intraday moves to expect. Research the rule of VIX. I don't really recommend doing TA on the VIX just because it can move so randomly at some points, especially if you're in a bearish market. There's really no point in putting TA on the VIX, but you should monitor it. Monitor it every once in a while and understand what kind of intraday moves to expect in the markets. And I really want to emphasize this at all also. As with anything in trading, I know Chris preaches this all the time. Trading is a game of probabilities. There's no certainty of what happens. Uh, when you build a system and you bring tools in like this, you are trying to increase the probability of your trades being correct and you making a profit as a result. Um, there will never be a full-on mastery to this. The best you can do is optimize your system, and you want to use tools like this to do so. And like I was saying before, I want to emphasize this also that positioning shifts rapidly all day. Kind of like I was saying, GEX is something that isn't something that you look at in the morning and you forget about it the rest of the day. It's something that you should monitor periodically. It should be a guide that tells you where price could go and what kind of environment price is working in right now. And then you should execute based on your TA. That is probably the most important thing that I want to get across in this is that this is not some secret tool and you all are going to be super profitable now. It's just another tool in your toolbox at the end of the day. And that is all I have. Um, okay, let me look at some Q&A. Okay. Uh, Looking for questions. Um, where was that question I saw earlier? Okay, let me pull up an example from today then. Would you say it's important to use tape when pairing with GEX? Let's say there's a large positive gamma or a call wall and you see heavy red prints on the tape, but SPX only takes a couple of ticks down. Is it safe to infer that a bullish signal and we will likely see a push to the next positive GEX as long as negative GEX is there to guide it? I think flow is pretty good as long as you can actually make an educated guess on if it is a long or a short. Um, for example, I see many times that that flow comes in, let's say it's two put strikes and they're happening at nearly the same time. One might think that that is super bearish, that holy crap, they're buying out of the money puts for a large amount, but that could actually be a bullish spread. And what you can do, and what I like to personally do in the markets, is I like to look for put spikes and call spikes that are out of the money. For example, a couple weeks ago, or I think it was like 1 or 2 weeks ago, we saw a large, I think it was 1,000 call on SPY. And what do you know what happened? The market actually started to get some selling in. Those signs will tell you. Um, it's not something that you necessarily need to monitor every single day, but in general, you can look for those out of the money put and call spikes because kind of something that you need to think about is if the market is massively overbought or oversold, what kind of person would be putting a large amount of money for it to rip another 10%, 20% higher or lower? That really doesn't make sense to me. So I would take those as being actual call sells or put sells. I've noticed that too sometimes when I see a large order hit the tape. Yes, yeah, exactly, exactly. And you can look at this specifically in bullish markets right now. You can look for those massive put spikes on the day. Um, those are going to be your keys to when the market actually V-shapes. That goes to that setup I was talking about the V-shape buyback. You will see those hit the tape, and then you will see it reclaim that negative gamma, and that will trigger the V-shape in the market. And then your target would just be uh, the next largest positive gamma. So that is correct. Yep. Thanks, Gumball. I'm trying to find an example. I guess what kind of example are you looking for? I guess maybe here I got one. Just take a snippet of this.